Hey everybody, Preston Bryn here with our Trader User Group, a weekly roundup. This is for the trading week ending September 16, 2016. What I've got on the screen here is the weekly chart of the E-mini S&P 500 futures. This past week we've seen volatility, certainly clearly come back into the markets. And then towards the end of the week, we've got, I think on Thursday, we had data, economic U.S. data coming out on retail sales, industrial production, wholesale inflation. All of this stuff came in rather poorly, but we're kind of in this environment that we've been in for quite some time that I'm sure many of you are familiar with. Is bad economic news or bad economic data is good news for price action, and price action reacted positively. And I think since that data came out, the S&P rose about 1%, I believe, since that data hit, all under the auspices of the belief that this will push the Feds off at least towards the end of the year, perhaps even longer, in raising rates, because the Feds are in a box right now. They're in a pickle. They say they're dependent on data, but I believe they're as much a political arm as they are anything else. But be that as it may, it's been a roller coaster week. And on this chart here, as you can see, again, it's a weekly chart, we actually finished up for the week. You can see here we opened the week here around 21.15, and we closed just below this line that I said it's acting just like a bug zapper on your back porch on a hot summer day. 21.34, which was the former all-time high, that it took us over 400 plus days to penetrate. And then when we penetrated it back over here in after July, early July, we quickly ran up and made new 2016 highs at 21.9150, all-time highs. And then I had said many times that because this level was a very key level and it took us so long to penetrate it, that we're going to probably, in all likelihood, come back and revisit that level. And that's exactly what we did. And it took us about from early July to early September, about 8 weeks roughly, to come back and revisit this line and penetrate it. So what was once a huge resistance point as we were trying to penetrate that line now becomes a huge resistance point again as we fall back through. It was a support point, but we broke it. So typically, that's why I've got this price level on my chart. It goes back probably through the May of 2015. So I've told our members that we've got to keep in mind this 21.34 level. And you can see on Friday, we actually closed just slightly below the 21.34 at 21.3250. So, about a point and a half, a couple of points south of the 21.34 level. I believe this is going to come back into play again. Now, on this weekly chart, I've got a pivot high of 21.56 and 2100.25. So this was the range for the week when volatility was introduced the previous week. To us when we were in this funk for really since July. When we broke out of the 21.34 level, we just kind of stayed in this funk right here for almost 2 months, and then we finally, broke down. So that was a little bit of an easier forecast to make. That was a higher probability trade in coming back down and testing this level. And most of our members, we saw some great gains in the volatility market because we were getting long volatility back over here. And this is the third time we've done anywhere from 200% to almost 1,000% returns on our volatility trades. Now we've got this week coming up, the CME website and the 30-day Fed Fund futures is pricing in about a 20% chance of a rate hike on Wednesday at 2 o'clock Eastern Standard Time. That'd be New York City time for all of you that are overseas. And we also have the Bank of Japan coming out with their data on the 20th and 21st, and then their announcement on the 21st. So it's going to be a very busy week. If the probabilities hold true and stand pat, and Yellen bellies up to the bar and she delivers her recipe for her blueberry pie, and the boys like it, we're going to go back up and we're going to test these highs that were made in the opening of this prior week, and we'll probably go higher. However, if she comes out and she puts a it's all about the dot plot and the glide path. Right now, the Fed, Yellen said the glide path for future interest rate hikes was something like that. Other Fed members came out and said, au contraire, it's going to be more like this. So this is what kind of set everything in motion and started the downward trek a couple of weeks ago. So everybody is going to be on pins and needles as Aunt B steps up to the podium and tells us what her true recipe is for the blueberry pie, aka the financial market. I don't want to guess. I don't even want to try and guess. Big money is not going to make commitments both long or short until they get an idea of what's going on here. There's a lot of what I call reindeer games going on right now with the currency market, the bond market. It started a couple of weeks ago when Mario Draghi said, we're not purchasing any more bonds. And that drove their yields in Germany and across Europe up, which drove the U.S. yields up dramatically. Money was coming out of the U.S. and it did a number on our bond market. I'll show you our bond chart here shortly. The other thing, Japan has come out and said they're going to do something opposite of what the U.S. Fed has been doing for the past 3 or 4 years before they ended their stimulus. The Fed's had a program called Operation Twist, where, you've got a yield curve like this, and this is, the 30-year out here, and then this is, let's say, the 2-year here. And Yellen wanted to drive the 30-year interest rates down. So they were doing a lot of purchasing right here. Now, Japan has come out and said, what we've been doing for 30, 20 years is not working. Now, Japan also has 50-year and 100-year bonds, which are absolutely insane. But Japan is saying they're going to be selling. They're going to do the opposite of Operation Twist. They're going to want to drive up the price on the upper end and drive down the price here to steepen this yield curve in the hopes of spurring inflation in an economy that's been stagnant for 2 decades. So they're going to do just the opposite. That's also created some agita in the global bond market. Keep in mind the global bond market right now, there's about 12.5, 13 trillion, depending on which data you read, that's negative interest rates. As those interest rates start to unwind and they go a little bit higher when you get further out on the yield curve, what's going to happen is you're going to see our bonds continue to go down, interest rates starting to go up, and what's really going to be interesting is the US dollar. So I'm getting a little bit ahead of myself here, but I wanted to show you for given all of the craziness in the markets this past week, we actually finished up. Okay, you can see where the all-time highs are with the E-minis at 2191.50 right here, this red dashed line here. So this is a weekly chart. If we zoom in and we just take a look at the daily, you can see here our forecast off the Brexit lows. We're pretty much dead on solid here, guys. Right off the Brexit lows on this daily chart right here, right in that area there, I was having folks getting long here because I had forecasted a resistance level right up in this area here. Done on a combination of Gann and Fibonacci extensions, but that was the higher probability move. The Gann gave us a timing aspect to the move, and the Fibonacci gave us a pricing aspect of the move. So when you put these together, it gave us a target time and date of around 8/8, and we literally hit it within about a week, maybe even a little bit less of that time. Now we were in this area for a very long period of time, and then we started loading up on long volatility right over here. And then of course on this daily chart we moved down to what I call a support zone right here, and here's where we sit. Now, are we going to go this way or are we going to go this way? Well, it's all going to be dependent on what Janet Yellen says, I think, at her 2:30 press conference. I believe there, again, my belief is no different than you guys out there listening to this audio or video, or watching it rather. But I believe she's not going to do anything, and she is going to be a little bit more hawkish than the market suspect, and we're going to sell off. Probably come down, test the 200 EMA, and then probably get some more buyers come back into the market and push it up. If that is her message, that's what we can expect. If she says that they raise the rates, then keep in mind, that'll be a surprise. The market has got about a 20% probability of a rate hike, so that would be a surprise. And as you guys know, markets hate surprise. We'll have a real fast sell-off. And then somewhere in this area here, we'll probably get some buyers stepping in, because the buyers will realize valuations are a little bit, they're not wildly expensive, but they're a little bit stretched given the current economic data we've got. But there's no place to go. The TINA, I'm sure you've heard the phrase TINA, there is no alternative to investments. But remember, as the yields and the interest rates start going up, there will be alternative investments to equities, and you will see some money come out of equities and go back into some of these securities because the interest rates are a little bit more competitive. Okay, so that's a little bit about what we got going on right now. It really is amazing. So we're on hold until we get this. Now, between Monday or Sunday night's open and then Wednesday afternoon, when we get that, we can expect some chop. We can expect some jockeying in position here. The other thing I will show you on this daily chart here, you can see we're sandwiched between the 200 EMA down here and the 50 EMA right here, and the 50 EMA is kind of providing resistance. You can also see I can draw this line like this. So we've got this what looks like a bear flag here from, we entered the pattern from high to low, so the odds favor a break to the downside, and then the width of the break would be something like this right here, which would put us somewhere down around this area down here. So that would be the technical analysis of the chart. But when you throw in the Fed and you throw in all the reindeer games that are going on, it's really, I'm not going to make any trades until I get an idea of what's coming out of this woman's mouth and the policy statement. Japan is going to, they're going to be leading things off, and then we're going to get this on Wednesday. Now, if we look at NASDAQ, through the likes of Google or Amazon and Apple, it's on a tear. If you look at the weekly chart on NASDAQ, and if I blow it up for you, right, let's just get it down here in perspective. Look at the weekly chart on NASDAQ. We entered the week down here towards the lows, and we finished near the highs. In fact, we finished near the 2016 highs for NASDAQ, all driven by some technology stocks where money seems to be going into right now. Okay, NASDAQ had been lagging the markets for almost all of 2015 going into 2016. That's starting to catch up. And you can see here, in fact, it probably has caught up. We took out a key level here, and then away we went to the races here. And now this is where we're sitting right at this point. Keep in mind, if they hike the rates and they surprise everybody, then all indexes are going to go down. But then you'll see some buyers step in on some better, more promising securities. Again, if we go to the daily chart, you can see here that we're well north of the 50 EMA, well north of the 200 EMA, we're well north of the 2016 open price, and we're approaching the 2016 highs. So if we get positive data out of the Fed, and let's say it's bullish, it drives bullish, it's more of a dovish kind of thing, NASDAQ is a good place to be, or the Qs. Okay, that's kind of where we're sitting here on this one. If we come down and we look at volatility, as I said, we got long vol before the big drop last week, and we did very well. Vol finished down 93 cents on Friday at 15.37. You can see here this big pop up and then this big rollover, but I'm not convinced yet that vol is done. We're still in zone 2. What's zone 2? Well, our members understand what it is. You guys may have seen me show this chart before, but each zone is color-coded based on the price of the VIX. And obviously, the higher you go into what I call black, which is kind of like the black swan when you get a VIX over 50. And it does happen. It happened last August. But generally, when you hang around zone 1, you do not want to be hanging out with option strategies that are essentially let's say essentially credit spreads. Once you get into zone 2, credit spreads become more palatable. We were setting some up when vol was up at this level here. If we get up to zone 3, then that's pretty much all you should be doing if you're an options trader, because if you're buying premium, you're making a big mistake up at this level. Okay, so vol right now is kind of caught in that no man's land, just slightly on the lower inside of zone 2 towards the upper inside of zone 1. So I think it's not going to go too far down or too far up until we get through the Fed. So we're going to watch that one really closely. For our members Sunday night, we'll take a look at some long Vega trades, long volatility trades again, as a hedge in case Yellen, nobody likes her blueberry pie and things go crazy. If we look at the bond market, remember what I told you at the very beginning here with the monkey and reindeer games going on from Mario Draghi now over to Great Britain. They raised their rates. I'm sorry, they lowered their rates a couple of weeks ago, but they didn't do anything this past week. They're not extending their bond buying program yet. They didn't do any more stimulus. And now we got Japan and we got the Feds coming out this Wednesday. But you can see the bond market has been in a steady decline, okay, from the 2016 highs that were made just back over on the second week of July. We've had a situation where bonds have just been selling off dramatically. We're now testing the 200 EMA. Can it go lower? Yeah, we're going to wait until we get some more clarity out of the Feds on Wednesday. But remember, a lot of this big up move in bonds wasn't necessarily driven by the American investor. It was driven by global money and funds flow from Japan and Europe based on what Draghi and Japan was doing, as well as China. But as some of that stuff starts to unwind, as I've said before, we're going to see some sell-off in the bond market. Now, don't get too giddy because I don't believe bonds are going to go too far down in the near term. Longer term, yes. Now, we've been playing this either short bonds or long TBT, depending on your proclivity. You can also go short TLT as well. But, you know, our method of choice so far has been long TBT. But you can see this range here. Now, on a 120-minute chart or a 2-hour chart, you can see just how volatile this down move is. And these are big moves in the bond market. We've gone from the low end of this to the high end, back to the low, back to the high, down to the low, to the high, down to the low, back up towards the high, and then we broke it here. We're coming up trying to test it again. You know, so, you know, connect the dots, right? I mean, we can just, it's a very volatile move, but yet there's no clear question that the vector's towards the downside. So if you're holding shorts in the bond market, sometimes it's very difficult to hold a short when you're, and it's basically about a 3 full handle move from the bottom to the top, and that's $3,000 per contract, you know, so you start questioning your strategy here if you're short. Overall, you would have been fine if you just held it, but this is an easier play in the options market in bond futures or in the options market on TLT or TBT than it is in just holding pure bond shorts in the futures market. You can be short bonds and then you can be selling calls up above it to help support some of these counter trend moves here because you can get a lot of premium in the bond market. So there are a number of different strategies that you can use to play this out, but it is clear that the vector is to the downside in the bond market. I've said that the bonds more than likely will probably come back up and do another retest, and if it starts to roll over for folks that miss this trade, that would be a good area here to just say, okay, I'm going to join the party and go back down again. Don't try and enter it down at the lows down here because you've got a very poor risk to reward ratio. Just a normal bounce up here would probably take you out, and then as soon as you get out, it'll roll right back over and you'll be cussing yourself again. You'll be on the wrong side of the trade. So that's kind of what I'm looking at the bond market right now. And then of course, if we come over and look at currencies, if we look at the US dollar, it finished strong on Friday. And naturally so, because the markets are anticipating a little bit more of a hawkish Fed. And if we come back to it, let's go look at a daily chart, kind of level set everything here. In the long run, we've really been stuck in this very wide range here, all right, right in that area there, all right, and we're almost towards the center of this range right here. And again, which way do we go? It depends on what the Fed say. Okay, if the Fed say that they're going to be more hawkish, you'll see the dollar go up. You'll probably see the bonds go down. You'll probably see the equity market go down a little bit. But I do believe the equity market, it'll go down a little bit, and then there'll probably be a rebound on that equity market. Okay, but that's kind of what we're looking at right now for next week. It's going to be a very interesting week. Now, in the bond market, as you know, we've been heavy, not the bond market, the British pound, we've been playing this very nicely over the past since the Brexit vote. We were short the British pound going through this whole process, did very well. And then we actually shifted over and I started going long right here. And then I set a tight stop. We got stopped out right here. And then down in this area here went long again. And then I set a tight stop and we got out here. So I was long here. I was long here. I was short here. So we played this very nicely. We had a huge downdraft on Friday in the bond market. I suspect the bonds are probably going to come down and test the 2016 lows around the 128 area. And if we can somehow eke out another little bit lower low, I'm going to go back long again. And for our members, we'll go into this, the pound trade. I believe the British pound is going to be a great long-term trade. Gold, flip a coin, guys. Gold has been in neverman land for quite some time. And again, I think longer term, I'm probably more bullish, but shorter term, I think gold could probably actually come down and test the 2050 area or the 1250 area again. It depends on what the Feds do. If they get more hawkish, you're going to see gold sell off. Okay, it's as simple as that. If we look at oil, well, a really interesting thing with oil, it finished down 72 cents on Friday. And as I've been telling our members, I was hoping oil would come up to the 50 level. It did not, but I've been telling our members to sell calls out of the money in oil futures, or you can pick up in the money bear put spreads in USO, or just long puts in USO. I believe oil is not done yet. Remember, we got a meeting coming up with OPEC and non-OPEC countries to see if they can agree to a production freeze or some kind of controls. But keep in mind, they're already at the highest production levels they've ever been at. So a production freeze at their already high levels really means nothing. Except for price action, there'll be a psychological move higher. If we get that psychological move higher, if they can agree to this, which I still don't believe they can, neither do the markets, we'll have oil come back up into this area here, and then I'll be more than interested in doing a short because the fundamentals are just not there, guys. We've got a lot of excess oil inventory, and I believe that that's going to wash itself through the system. It's going to take 6 months to a year to do that, and it's going to drive the price of oil lower. But near term, on a 3, 4, 5 day basis or a week or so, we could have this giddiness that drives the oil higher if we get something out of OPEC, which again I do not believe. The other thing is we're entering into the seasonality period where oil and gasoline tend to be the weakest. So that is another favor for the bears. So that's kind of what we're doing with oil. For our members, we'll go into detail Sunday night on some ways to play this. If you're not a member, I'd highly encourage you to come on in and check us out. In the corn market, wheat market, soybean market, as you knew, I got long corn here, and then I just stopped out for some small profits. There's some better trades to be made in the ag market. We're going to look at them this Sunday night for our weekly market watch coming up for next week. But you can see the corn down here, the 2016 low actually made a new 2016 low back over here on the 12th of August. And this is kind of where we're sitting right now. And you can also look at wheat. Wheat did the same thing. Wheat has come down and it's hovering around its 2016 lows right here. All right. And then if we look at soybeans, it's probably the best of the three in the ag. You can see soybeans, even though it's near the lows, it's not near the 2016 lows, which are down here. You can see that, the 2016 open price and the 2016 lows are almost the same. And we're in this really wider support zone that's formed off a weekly chart. So I do believe that the bottom is being formed in the ag market, and we've got some opportunities here. Near term for steadiness, maybe slightly lower, but not too much lower. In the softs, well, as you guys know, I was trying to play sugar to the downside, and it just like upended everything on Friday. So I just got stopped out for a small loss in the sugar market. It's making a really interesting move here. I do believe that there's going to be a better entry price for those that want to get short sugar. If we look at the weekly chart, there's still an ample supply of sugar on the world market. But you can see sugar can make these huge runs. But once it does, then we want to be on the short side of the stick because sugar does not stay up here. We had a run back in 2010. We had a run back in 2011. We had we had 2 runs in 2011, and then it's just been all downhill since. And if we go way back in time here, you can see that sugar it doesn't stay up at these levels very long. All right, we haven't been at this level since 2012. And can we run higher? Sure, I think we can run a little bit higher, but I do believe I want to look at maybe possibly setting up a short in sugar again. Now is not the time to do it. The other area is orange juice. Orange juice, typically we're seeing a really strong run in OJ. OJ is even more extended. If we go back in time on OJ, look at this. You can see these highs here, one made in 07, one made in 2012, and now we're here right at these levels. Now it can stay up here for a couple of weeks at a time. I just don't believe it's going to stay up here for too long. And when OJ falls, my goodness, it's a great trade. I mean, when it goes down, look at that. It goes down. It just goes hard. And you know, generally when OJ gets up at these levels, when it starts going, it goes. So this is another one that we're going to be watching in the softs market for OJ. Then finally, the other one in the commodity complex is meats. You can see here with meats, we're really moving down low here in the meat market. We're getting down to these lows that we haven't seen going all the way back to 2010. Okay, I mean, just very, very low here. So I believe that we're going to find a bottom down here, and then we're going to settle in, and then we're going to move back higher. So I will be looking, not now, but I will be looking, and here's the weekly for feeder cattle. You can see feeder cattle also, you know, down near the lows here like this. So I believe that the same thing is going to happen with feeder cattle. And then if we look at lean hogs. Lean hogs is the same way. We had this huge downdraft here this past week, and maybe you can't see it on the weekly. Let's go to the daily, and you can just see what it did. I mean, if you look at this chart here, lean hogs just really, you know, this is a true evidence that pigs really can't fly. But in the commodity complex, what you got to understand is that you get these overextensions both up and down, and we definitely want to take advantage of them. All right, so now is not the time to look at the trade, but there will be a time for this, and it'll be really interesting. All right, everybody, that's pretty much my update for this week. We got the Fed coming out on Wednesday, the 21st. We got the Bank of Japan coming out on the 21st. It's going to be, the volatility is going to stay in the market. And don't try and guess what they're going to do, because you're going to, it's just, you know, flip a coin. React to the market price. For our members, I'll see you Sunday night, and we'll come up and we'll identify a couple of trades we can do on a hawkish Fed note, and a couple of trades we can set up on a dovish Fed note, and then we'll have them ready to go. Okay. Otherwise, everybody have a great weekend, and I will see you next week. Ciao, everybody.